There is a building on Fifth Avenue in Manhattan that has not made a dollar of profit in over a decade. The developer knows this, his accountant knows this, the bank that financed it definitely knows this. And yet, on paper, the developer is wealthier today than when he broke ground. His tax bill is lower than yours, and the bank is not worried. That is not a bug. That is the entire point. Real estate is the only investment class in America where you can legally lose money on paper, pay almost no taxes, borrow against an asset you do not fully own, and still build generational wealth. And the rules that make all of that possible were not written by accident. They were written by people who already owned property. This is not a story about house flipping or becoming a landlord in your spare time. This is a story about why the wealthiest people in America, the kind who never have to work again, almost always have one thing in common. And it is not the stock market. It is not crypto. It is not some secret hedge fund. It is real estate. It has always been real estate. And once you understand why, you will never look at a building the same way again. Let's start with a number, 90. As in, roughly 90% of the world's millionaires have built or preserved their wealth through real estate at some point. That statistic gets thrown around a lot. It's on motivational posters. It's in the intro of every real estate course that costs $2,000 and teaches you nothing useful. But here's the thing. The number is real, and almost nobody asks the right follow-up question, which is, why? Not how do I do it, not what market should I invest in. The actual question, what is it about real estate specifically that makes it such an effective wealth-building machine? Because if you don't understand the mechanism, you cannot use it. You're just copying behavior without understanding the system. So let's understand the system. It starts with something called leverage. And this is where most people stop paying attention, which is exactly why most people stay where they are financially. Here's what leverage means in plain English. You want to buy a stock worth $100,000. You have $20,000. The brokerage says you can buy $20,000 worth of stock. That's it. If the stock goes up 10%, you make $2,000 on your $20,000, a 10% return. Now you want to buy a house worth $100,000. You have $20,000. The bank says, put down your $20,000 and we'll lend you the other $80,000. You now control a $100,000 asset with $20,000 of your own money. If that house goes up 10%, it's now worth $110,000. Your equity just went from $20,000 to $30,000. That is a 50% return on your actual cash. Same percentage increase in value, completely different outcome. That is leverage, and banks will give it to you for real estate in a way they will not give it to you for almost anything else. Not because banks are generous, because real estate is collateral they understand. It doesn't disappear, it doesn't go to zero, it sits there, and if you stop paying, they take it. This is the first reason wealthy people love real estate. It lets you control large assets with relatively small amounts of your own money, and that amplification effect over time is staggering. But leverage alone doesn't explain everything, because leverage also amplifies losses. Borrow 80% of an asset's value and watch that asset drop 20% and suddenly you owe more than it's worth. This happened. We all remember 2008. So there has to be something else, something that makes real estate more reliable than other leveraged pets. And there is. It's called the underlying demand problem. People need shelter. That sounds obvious, but think about what that actually means as an investment thesis. When you buy shares in a company, you're betting on future earnings, on management decisions, on consumer tastes, on competition, on 1,000 variables that are almost impossible to predict. That company can be disrupted. Blockbuster was disrupted. Kodak was disrupted. Entire industries have vanished inside of a decade. Nobody has disrupted the need for a roof over your head. The U.S. population grows by roughly 2 to 3 million people every year. That's 2 to 3 million people who need somewhere to live. And meanwhile, since the 2008 crash, the country has been massively underbuilding housing. We're talking about a shortage of 3 to 5 million units by most credible estimates. Some say more. Supply constrained, demand structurally guaranteed. That is not a speculative bet. That is arithmetic. And wealthy investors understand this. They're not buying property because they read a blog post. They're buying because the math around housing scarcity is about as close to a sure thing as investing gets. Now here is where it gets genuinely interesting. Let's talk about what the government does for real estate investors, not what it does for you when you work a job and pay income tax. What it specifically does for people who own income-producing property. It is a different universe. The first gift is called the mortgage interest deduction. If you borrow money to buy real estate, the interest you pay on that loan is tax deductible. You're paying the bank, and the government reduces your taxable income because of it. On a $500,000 mortgage at a 7% interest rate, you're paying roughly $35,000 a year in interest in the early years. That $35,000 comes off your taxable income. The second gift is depreciation, and this one is the one people outside real estate almost never understand. The IRS allows real estate investors to treat the physical structure of a building as something that gradually wears out, like a piece of machinery. Over time, you can deduct a portion of the building's value every year as an expense, even though the building isn't actually losing value. In fact, it might be appreciating. But on paper, you're recording a loss. Residential property depreciates over 27.5 years, commercial property over 39 years. So if you buy a rental property with a building value of $275,000, you can deduct $10,000 per year in depreciation. That's $10,000 of income that gets sheltered from taxes every year for nearly 3 decades. The building didn't actually lose value. You didn't spend that money, but the deduction is real. This is how a real estate investor collect rent, make money, and simultaneously show a tax loss. It's not fraud, it's the tax code working exactly as designed.
Now let's push this further. Because wealthy investors don't just use depreciation, they use something called accelerated depreciation, which allows them to front-load those deductions massively in the early years of ownership. And then they use cost segregation studies, basically an engineering analysis that breaks down a building into its component parts, assigns faster depreciation schedules to things like flooring, fixtures, and electrical systems, and generates enormous paper losses up front. We're talking about buying a $2 million commercial property and generating $400,000 or $500,000 in deductions in year one. Deductions that wipe out income from other investments. Deductions that, if you qualify as a real estate professional in the eyes of the IRS, can even offset your ordinary income. Most people don't know this exists. Most people who do know about it can't use it effectively because they don't have enough real estate income to make the mechanics work. But once you reach a certain scale, the tax code becomes something else entirely. It becomes a machine that generates paper losses on appreciating assets and distributes those losses across your tax liability. Rich people don't just pay lower taxes because they have accountants. They pay lower taxes because the rules governing real estate investment were written to do exactly that.
All right, let's talk about the moment the whole thing clicks into something almost poetic. It's called the 1031 exchange. Here is the rule. If you sell an investment property and use the proceeds to buy another investment property of equal or greater value within a specific time frame, you pay zero capital gains tax on the sale. Zero. You made $300,000 on a property. Normally, you would owe capital gains tax on that. But if you roll it into the next deal, you defer the tax. Then, when you sell that property, you roll it into the next deal and defer again. You can do this indefinitely. The wealthy real estate investor is playing an entirely different version of the tax game. They are building equity, compounding value, and in many cases paying no tax on gains until they die. And when they die, the properties pass to their heirs with something called a stepped-up basis, meaning the taxable gain essentially resets to zero. Generational wealth, legally, by design. Let that sit for a second. You go to work. You earn a salary. The government taxes it before you even see it. You invest the remainder. You pay capital gains when you sell. You build wealth slowly in after-tax dollars your entire life. A sophisticated real estate investor earns rental income partially sheltered by depreciation. They sell properties without paying capital gains by exchanging into new ones. They borrow against their equity instead of selling, so no taxable event at all. They die and pass the assets to their children with the tax clock reset. Same country, same laws, wildly different financial outcomes.
This is the point where someone usually says, okay, but what about regular people? What about the homeowner who just bought a house in the suburbs? And this is where we have to be honest about something uncomfortable. The real estate wealth machine works on a spectrum, and at the lower end of that spectrum, the first-time home buyer, the small landlord with one rental unit, the benefits are real but modest. You get the mortgage interest deduction if you itemize, which fewer Americans do since the 2017 tax law changes raised the standard deduction. You get to exclude up to $250,000 in capital gains on your primary home when you sell if you've lived there 2 of the last 5 years. That's meaningful. But you are not doing 1031 exchanges. You are not running cost segregation studies. You are not sheltering W-2 income with real estate professional status. Those tools are for investors playing at a different scale. The uncomfortable math is this: real estate rewards scale disproportionately. The more you own, the more the tax advantages compound. The more collateral you have, the better loan terms you get. The more units you control, the more you can spread costs across income streams and make the numbers work. A person with 1 rental property is managing a side hustle. A person with 20 properties is running a tax-advantaged business. A person with 200 properties is operating a private economy with its own rules. The entry point matters, and right now, that entry point is higher than it has been in decades. Which brings us to where we are right now, because this is not an abstract history lesson. This is a live situation with very real stakes. Since 2020, home prices in the United States have increased by roughly 40 to 50% in many markets. Interest rates went from historic lows near 3% to above 7% in the span of about 18 months. The monthly payment on a median-priced home is now higher than it has been at almost any point in modern history relative to median income. And yet, institutional investors, large real estate private equity firms, real estate investment trusts, family offices are still buying. They bought through the rate hike cycle, they're buying now. Why? Because their cost of capital isn't always what yours is, because they have equity from previous appreciation to deploy, because they can absorb higher rates in the short term and wait, because they understand that the structural housing shortage does not resolve just because mortgage rates went up. In fact, high rates reduce housing supply further because existing homeowners with 3% mortgages are locked in and won't sell. Inventory stays low, prices stay elevated, the machine keeps running. The person who is most hurt by this environment is the first-time buyer, the person trying to get into the game, who has no existing equity, no appreciation to leverage, no portfolio to 1031 exchange. They are trying to buy in at the top of a market built over decades of policy decisions they had no part in making. Now, let's zoom out, way out, because there is a bigger story underneath this one. The reason real estate has these extraordinary tax advantages is not a coincidence. It is a policy choice, and that policy was shaped by people who owned real estate. Since the early 20th century, real estate interests have been among the most powerful lobbying forces in American politics. The National Association of Realtors consistently ranks as one of the top lobbying spenders in Washington year after year. The depreciation rules, the 1031 exchange, the mortgage interest deduction, all of these were put in place under the argument that they encourage investment in housing, that they stimulate construction, that they keep the housing market healthy. And there is some truth in that. Real estate investment does finance construction. Rental housing does provide homes for millions of people who can't or don't want to own. The system is not purely extractive. But the 1031 exchange allows a billionaire to defer taxes on real estate gains indefinitely in ways that a small investor selling stocks cannot replicate. Accelerated depreciation disproportionately benefits large institutional buyers. The stepped-up basis at death is one of the most significant transfers of untaxed wealth in the American economy. The rules were written for scale, and the people at scale wrote the rules. This is not a conspiracy theory. It is just the ordinary mechanics of how economic policy gets made in a country where owning capital gives you access to political influence, and owning more capital gives you more of it.
Here is the honest conclusion that most real estate content will never give you. Real estate is genuinely one of the most powerful wealth-building mechanisms available to ordinary Americans. The leverage, the cash flow, the inflation hedge, the tax treatment, it is all real. If you can get in, if you can hold, if you can scale, the math is strikingly favorable over long time horizons. But the wealth machine was not designed to be democratic. It was designed by people who already had capital, for people who have capital. The advantages accelerate as you climb. The barriers are real, and the current environment, elevated prices, high rates, constrained supply, makes entry harder than it has been for a generation. Wealthy people love real estate because it is the one asset class where the government essentially subsidizes your wealth accumulation through the tax code, where borrowed money works in your favor at a scale not available anywhere else, and where the underlying demand for housing means time almost always bails you out even when you make mistakes. It is patient money. It is boring money in the best possible way, and it compounds quietly while everyone else is watching stocks tick up and down on their phones. The real estate investor is not watching a screen. They are watching a building, and that building is collecting rent, depreciating on paper, appreciating in reality, and slowly, invisibly, the equity accumulates. That is the trick. That is the whole trick. The system is not secret, the rules are public, the tax code is available to read. None of this is hidden. It's just complex enough that most people never sit down and actually trace the logic from beginning to end. You just did.
So here's the question worth sitting with. If the rules are public, if the mechanism is knowable, if this system has been operating in plain sight for 100 years, then the real question is not why rich people love real estate. The real question is who decided that the rules should work this way, and whether those rules still make sense in a country where 40% of renters spend more than a third of their income just to keep a roof over their heads. The tax code that helps a billionaire defer capital gains forever is the same tax code that offers a struggling first-time buyer a deduction they can no longer even use. Whether that is a feature or a bug depends entirely on where you're standing, and that is a question this video cannot answer for you.